Breaking news just out. Our lending regulator has come to property investors and smashed them down in a permanent change that impacts property investors all across the country. I've been saying it on this channel for a few weeks now. They are coming, changes are happening, property investors are the target, and today we now have a permanent change. I'll say that again, a permanent change to our lending system that impacts property investors for the years ahead. In this video, I'm going to go through APRA's breaking announcement step by step and show you exactly why they are doing this, what it means for you, and how this changes property investing for the long term. We're also going to run through exactly what it may mean and what we don't know yet, because we don't have all the answers right now and changes are coming. Uncertainty is the environment that property investors are operating in today, and you need to know exactly how to act. Let's go. This is their announcement. It's the deeper version of their announcement where they've come out and they explained exactly what they are doing. Let me unpack this for you in language that makes sense, because there's a lot of words here, a lot of names here. It's a little bit confusing. And if you don't know, I'm Reedham Syed, ex-Treasury economist that has a background in international monetary systems. Today, I run Flint Group, one of Australia's largest mortgage broking companies, where we lodge over $1.5 billion in mortgages every single year. And I get the sense of property investors all across Australia, their behavior, their motivations, and what they are thinking. I also run Alea Property, a buyer's agent company that feels their momentum and helps property investors buy, scale, and grow their property portfolios. If you need help with either of those, you can go into the comments below and speak to our team. So here, the big context to the whole lending landscape in Australia. There's actually one main rule. Just one simple rule that APRA use to govern the whole way our mortgage lending system works. Yes, there's a whole lot of detail. Yes, they've got rule books, handbooks, guidelines, all this stuff. But underlying is one key principle, just one. It's the assessment rate buffer, and APRA have a 3% assessment rate buffer, which means that for every person trying to go and get a loan, the bank assumes the interest rate is 3% higher than the current rate, and that is the buffer that they're assuming when they're working out how much money they lend to you. Now, if you assume 3% higher than the actual rate, you're actually ending up with quite a large buffer for people to be able to make repayments in changing circumstances. Because the buffer rate is so high, it kind of covers everything as like a little bit of a catch-all scenario. If someone loses their job, goes part-time for a little bit, doesn't make their income over the next 30 years, we can't really plan for all of those things. So as a governing body, they come up with one rule and they say, cool, for all the uncertainty that people have into their future, let's have a buffer and lend you much less than you can actually afford. That protects us. It protects the financial system. Because if people are getting more money than they can afford, then it is dangerous for our entire financial system, because people may not be able to repay their loans into the future. That's a pretty simple concept. Anyone seen those movies back in the day? The Big Short, things like that. 2008 was what happens when you give people loans who can't pay them back. We have experienced this before. The whole international world system has figured this out. We get greedy sometimes, and then we let people have too much money because greedy people want more money. They want to make more money. They want to buy homes. They want to live better lives, etc., etc. And then we end up lending too much money, and eventually the house of cards goes and crumbles. That has happened in the past. The way APRA deals with it is they have this one big rule, this 3% assessment rate buffer, to protect us all. That's why today's news is so big. We have just introduced to mortgage lending rule number 2. Let me say that again. We have a second rule on top of that 3% assessment rate buffer. And if I'm understanding this correctly, and I'm pretty sure I've got this right, APRA mean this permanently. They're not talking about a temporary change because investor lending's too hot at the moment. They are talking about a change to our financial system forever. Okay, maybe that's a little bit extreme, but at least for the next 5 to 10 years, they plan on keeping it like this. So let's go through what the rule actually is. APRA said authorized institutions can only issue 20% of new home loans at 6 times the borrower's income or higher. This cap will apply separately to owner-occupiers and investors. So they have two effective rules here, one for owner-occupiers, one for investors. You can't have more than 1/5 of all loans, so 20% of all loans cannot be to people who are trying to stretch their borrowing power to the absolute limits. You need to make sure that people are not borrowing all the way to their limits, and you need to kind of rein it in, is what APRA is telling the banks. Don't give more than 1 in 5 borrowers the absolute push it to the maximum, the limits as to the amount of money you can borrow in any environment. That's kind of the gist of what they're saying in really layman's language. People want to borrow a lot of money, the absolute maximum. APRA is saying, hey, can you kind of cool that down a little bit? Because that's where the danger is. But here's the really, really interesting thing. This announcement isn't really for the now. Bit crazy, they released it today, but it's not really for the now. I know this because in the very next line, they say about 10% of new investor loans and 4% of owner-occupied loans sit at or above the 6 times debt to income level at the moment. Did I just say that? Let me just say that to you again. Investor loans, 10% of them are above the 6 times threshold, and owner-occupier loans are at 4% above this threshold. Yeah, I'm just as confused as you are. When you say that out loud, it is a little bit like, what are you talking about? Didn't you just say that they put a cap at 20% here and we are only at 10%? What? That's a bit crazy. It's like you can get to here, but you're only here, so you can kind of still double? Is that what you're saying, APRA? And this is the crazy thing. It is what they're saying. They are actually saying that. They're talking about a long-term change here, not one for the now, not something that impacts banks and their lending policies right now on aggregate, on mass. Now, this is where it's really important for property investors. In the lender space, there are so many lenders. There's like 40, 50 of them. Most lenders are operating well below this level, and when you aggregate them all together, you're sitting at that 10% level. But some individual lenders within this broad scope here, they're sitting above that 10, 20% level. There's probably a few well above that 20% level at the moment. And APRA plan on implementing this policy at a lender level. It's an aggregate change, but they're applying it to each individual lender and saying that lender must be below 20% as well. So stripping this back a little bit, for property investors, there are some property investors that are going to some banks that offer additional money to continue to expand their property portfolios, and those banks may end up having that 20% plus threshold, and those are the ones that are going to have their policies change to limit down how much money they lend to you. But the broad majority, like 99% of lenders or 95% of lenders, they're not going to make any changes with this at all right now. This begs the question, why are you doing it at all? I had thought about this and I'm like, why are they doing it? Is it just them going, posturing around like a little gorilla out there being like, I'm here, I'm here, I'm here, watch out, don't you forget the policeman is here. There's an element of that. That's the reality here. They've timed the announcement here right after Macquarie, right after CBA, another announcement. Investors are in the market. They're trying to scare you. They are being posturing. They're like the bully in the schoolyard that's being like, hey, I'm taller, I'm bigger, I'm stronger than you. I can change your behavior without actually doing anything. Maybe I just scare you a little bit. That is partly what's happening, but they're also doing it preemptively. And the reason why is when you look at this chart, you can see exactly what's going on. Investor credit growth or credit growth levels do go up every single time interest rates come down. And there is scope for interest rates to continue coming down in 2026 and 2027 and 2028. And when that happens, credit growth will continue to increase. And then these lending caps, these 10% and 4% numbers, are going to get closer and closer to that 20% level because borrowers are going to be able to get more money. In this chart, you can see the concentration of lending as well. And you can see debt to incomes above 6, it's sitting well below 10% at the moment. And this is what they're targeting, this purple line here. And this purple line, it's nowhere near 20%. So they're saying that, hey, it could be above 20% at some point. And if you go back to the year 2021 here, you can see it was above 20% for a few months or a year or so between 2021 and 2022, where it got up to 25%. And they're saying, hey, you can never, ever, ever go above that at a system level, and at an individual lender level, you can't go above that as well. So We should never ever get there again while this policy is there, because this is the second structural change they've made to the lending system that's kind of blocked this 2021 experience from happening ever again. That's what they're doing. They're acting preemptively before there's potential rate cuts or assessment rate cuts. Maybe they're going to do that. Crazy idea, but maybe they're going to do that. Before they make changes or before there's variable factor changes like those rate cuts, they're putting in this cap preemptively. They talk about it here, why they're doing it. I've kind of already covered that. High risk lending, dangerous, people borrow too much money, you end up with the house of cards, big giant financial crisis, messy, messy, messy. We don't want any of that. So they're kind of saying that this is risky. If people have borrowed too much money, that's dangerous. That really makes a lot of sense. It's pretty simple, and they've targeted individual risky areas. They've also got this cool table of what every other country does, and they've noticed that all these other countries actually have these hard caps that are permanent features of their lending system. You got Canada, Ireland, New Zealand, Norway, UK here, and they've got a different debt to income thresholds. Very, very interesting, isn't it? I love this chart. It's so good. Canada, you can borrow 4.5 times your income. Ireland, 3.5 times. Norway, 5 times. UK, 4.5 times. Australia, 6 times. Australia, you have more debt. You go take it on. You go buy homes. Let's go promote the economy. It's really, really funny. You put this chart here and you've just shown that Australia and New Zealand are the ones that are saying, you take more money, Australians, New Zealanders. We like a debt-fueled economy. We like you buying property left, right, and center. That's what this table says versus other countries. You want to know why house prices are more unaffordable in this country? This table tells you exactly why. We let people have more money. Because we let people have more money, house prices are higher. So just a function of money supply, that's in here. This really cool table shows that 10 and 4% figure. I'm just going through exactly what APRA announced here. It also showcases we're not even close to that 20% limit right now, exactly what I touched on. They've talked about how all the different banks in the marketplace are sitting in terms of where they are at relative to this 20%. Again, no one's even close. And they've got a lot of analysis and lots of charts here about different types of lending. Now, one of the key takeaways, one of the interesting points here, and this is my ex-Treasury brain racking it all together to try and unpack this for you and working out what do APRA plan on doing here. Now, I'm a mortgage broker. I know exactly how to get property investors more money. It's my job. It's literally what people pay me to do. So I know how to do that. I know exactly what they're cutting back on. And this is where it's really interesting. The way to get a property investor to a DTI above 6 across their property portfolio is very, very possible. We can get them to 8. We can build out property portfolios over time. We might even be able to get them to 10 with some, creative planning and structuring to get them there and have some clear roadmaps about which lenders to go to at what point in time. And if you follow a plan, you can get more money from banks. A lot of property investors want that because it's a key tool to getting more wealth over time. And we talk a lot about that on this channel. This is where it's really, really interesting. APRA, the regulatory body, their main job is to regulate ADIs. In other words, big banks. If I wanted to get a property investor more money, I actually send them to small banks because these small banks, they're the ones that aren't using this 3% assessment rate buffer. Cheeky. These little banks are a bit naughty. They're just out there with a 1% buffer and being like, APRA's rules, they don't apply to me. I am doing what I want. Property investors want money. I'm a bank. My job is to make money. I want to give them money. Cha-ching. That is kind of how they operate. The interesting part here is, will APRA apply these changes to those banks? Now, it's not typically in their mandate, but if you drill down into the scope of what APRA can do, they have the means to go and do this. If they wanted to, they can force these lenders, these group of lenders over here that lend you a lot more money to rein it in. And if they do, then property investors, they're having the companies and trust door shut on them. I've talked about that in the last few videos with CBA and Macquarie. If they shut this down, then it shuts a property investor's ability to keep getting more and more debt, and it stops you from going from 3 to 6 properties, and you're going to be capped at that 3 level because you have to stick to major banks. This is where it gets really, really interesting. And my take on it is, I've done the research, I've looked at it, I've watched their wording, the very careful wording that they've crafted. They do not plan on applying these rules to these non-ADIs yet. They may look into it, and if it gets bigger and bigger, they may then go and target it, but for now, they don't plan on doing it. And here's my final take. This is more about the market as a whole. APRA's here intervening in the market with this, long-term change here. But realistically, I actually think the market will do what the market does. It will calm down all by itself. Right now, property investors are falling over themselves, tripping over themselves, being like, I want money, I want money, I want money, I want to buy, I want to buy, I want to buy. Don't I know this? We've never been busier at both Alaya and Flint Invest. It is absolutely bonkers right now where everyone is out there being like, hey, I need some help. And I'm a property investor. I need you to go and help me buy some great properties and get me some great lending structures. That is more potent than I have ever seen it right now. But here's the thing, that won't last. Interest rates are still pretty high. And the story and the narrative of interest rates is they're not going to come down much further over the next year or two. And if that's the case, property investors will just slow down naturally. They're going to run the calcs on their computer and be like, what? Do I really want a 3.5% yield in Adelaide and pay 20 grand out of my pocket every year to go buy a property in Adelaide? Same thing's going to be said in most capitals soon enough. You can say the same thing in Brisbane, Sydney, in Melbourne as well. It's across the country. They're going to be like, it doesn't actually make sense for me to invest so much of my money here because the numbers are not as compelling. Yes, property prices will grow a lot over the next 12 months, and we've done a few videos on that, and more is coming. We have a property price prediction video being released very, very soon. But this is something that we can actually self-regulate. You might not need any of these changes. The government can just be like, look, the market be the market. I don't need to get involved with these unnecessary changes that do nothing. Really, that's the summary of this video. This change does nothing. That's really what I'm saying. But other than the big posturing element that could impact confidence, they may not need to get involved because I suspect in the next year or so, we're going to have this boom, but then it's going to tail off because the market just dictates that's exactly what should happen.